This is Horizons Middle East and Africa. Our top stories this morning. Class action. The US orders Harvard to stop international enrollments, setting the stage for a court battle. Meantime, President Trump quotes, "Big, beautiful tax bill passes the House," but the bond market is not convinced. Third time's a charm. Bloomberg has learned OPEC Plus members are discussing another supersized output hike for July. Plus, trade tightrope, how the world's biggest cobalt producer is balancing its China investment while wooing the White House. It has just gone 8 a.m. across the Emirates, 5 a.m. here in the UK. I'm Tom McKenzie in London. Let's check in on your markets then, with the focus continuing to be, of course, on the bond markets, but also inflation data out of Japan. Top line in terms of what we're seeing across Asia, a positive session. You're on track now for a sixth consecutive week of gains across Asia, with the benchmark regional gains currently up 0.5% in the session today. European futures pointing higher by around 0.2% after a little bit of softness yesterday, falling across that benchmark stock 600 here in Europe by around 0.6%. Today, European equity futures flagged on the front foot. The 10-year at 4.52. You did see moves lower in yields across the curve yesterday. The 30-year remains above 5%, but you did see that further readjustment. We heard from Fed speakers once again suggesting, Chris Waller of the Federal Reserve suggesting that there could be cuts in the second half of the year if tariffs come down to closer to that 10%. The Japanese yen in focus, 143 right now, currently up 0.4% versus the US dollar. Inflation coming in higher for Japan at around 3.5%. Let's flip the board and have a look then. Cross asset, we focus on the oil story with reports that OPEC Plus is preparing for further output in July. We'll break that story down for you. Currently down 0.7% then at $64 a barrel on Brent. Gold getting another lift in the session today, up 0.3%, gaining currently 8 points at $3,303 per troy ounce. And Bitcoin remaining above that 110,000 level that it crossed for the first time in history yesterday. Further very modest gains for the biggest cryptocurrency by market cap at 111,000 per coin. Now, President Trump's signature tax bill is heading to the US Senate. After a narrow win in the House, the policy is poised to deepen the fiscal deficit, and the bond markets are questioning, of course, the beauty of Trump's big, beautiful bill. Let's bring in our government reporter, John Herskowitz, for the latest. John, where do we stand in terms of next steps for a bill that managed to get its way through the House? It goes to the Senate. What is the likelihood of a smooth passage through the Senate?
Well, given what's going on with the bill, nothing has been smooth sailing. The Senate is going to use the process of reconciliation. It's a fast-track thing, which only requires a simple majority. There's some procedural things that require a 60-vote majority, which would make it difficult to pass. Republicans have a slim majority in the Senate. But Republicans in the Senate are calling for changes. There are some calls to make the tax cuts in the bill permanent. There are also concerns about the cuts to social safety net programs like Medicaid, which provides insurance for low-income groups, and also for food stamp programs, nutrition programs to help poorer families get food. So some of these are concerns. It's not going to be easy in the Senate. There's always a fight with this, but that's where it is now.
How closely are lawmakers in Washington? How closely is the White House watching the bond market reaction to a bill that, at least on the top level, the headline level, will look to increase and likely increase that US deficit?
Yeah, I don't know the actual concern, but there are people who are watching the bond markets closely. I mean, according to the Congressional Budget Office, before some readjustments were made to the bill that passed the House, this bill was set to increase the deficit by about $3.8 trillion by 2034. I mean, this really caused jitters in the bond market. We've seen some downgrades of the U.S. sovereign rating. The 30-year is at 5% or so. And The worries about high interest rates are that they could really hurt the economy, make it more difficult for housing, and also just make it more difficult for borrowing. So these could really put the brakes on the economy, provide a lot of harm. And as the saying goes, the bond market is king, and the bond market is not looking favorably on what's coming out of the U.S. Congress.
Okay, Government Editor John Herskovits, thank you very much indeed on the latest when it comes to that big, quote, beautiful bill working its way through, of course, the corridors of power in Washington, D.C., with, of course, the scrutiny from the bond markets. We're going to check in some other stories in terms of the headlines crossing. The details, of course, this Friday. The Trump administration is blocking Harvard University from enrolling international students, escalating its fight with the elite U.S. college. The ruling will compound Harvard's financial pressures after the White House cut billions of dollars in funding and future grants. Homeland Security Secretary Kristi Noem says the blockade may be extended to other universities. The U.S. Supreme Court has shielded the Fed from President Trump's push to oust top officials at independent agencies. The court ruled the Fed is a uniquely structured, quasi-private entity. The decision is likely to quell concerns, for now at least, that the president might move to fire Jerome Powell. But the top court upheld Trump's powers to fire leaders from other U.S. agencies. The White House says President Trump will be attending the Group of Seven summit held in Canada in June. G7 finance ministers and central bank governors have pledged to address what they call excessive imbalances in the global economy. That appears to be directed at China, although the final communiqué of their meeting in Canada didn't name any specific country. Canada's finance minister says the group had frank discussions and found areas of agreement, including on US tariff policy. Dutch Prime Minister Dick Schoof also confirmed Trump will be attending the NATO summit in The Hague next month. Now, Bloomberg has learned that OPEC Plus members are discussing a third consecutive increase in oil production in July. A final decision is due to be taken at the gathering on June 1st. Let's bring in Nicholas Law, Bloomberg's oil reporter now for the latest. Nicholas, what is OPEC Plus planning for its July oil production increase? What do we know about how they are thinking about that next decision, and what underscores, what is underpinning a decision potentially to put additional barrels on the market at a time of pressure on oil prices?
Right. Well, I think first we want to say that OPEC is planning for July another supersize hike, so 411,000 barrels per day, and that will be the third supersize hike following two others in the previous months. And I would say that OPEC, this would represent a shift in OPEC policy. Previously, OPEC, before the announcement of these giant hikes, was defending oil prices at higher levels. Now it seems that OPEC is trying to defend market share. Now, various reasons have been adduced. Officially, OPEC has told, officials are saying that this supply hike is meant to support demand for oil. But I think there are other reasons that have been adduced. Among them, people are saying that Saudi Arabia, as well as the rest of the OPEC cartel, wants to keep Trump happy, and Trump has asked for lower oil prices. Another thing to flag, of course, is that this is a way for OPEC to strategically discipline its errant members like Kazakhstan and Iraq, who've historically been overproducing above their quota levels.
OK, so discipline is part of the rationale, as well as potentially a bit of a nod to President Trump. We're looking at pressure again on the oil markets. Right now, down 0.5% on Brent at $64 a barrel. How much of this is priced into the markets at this point in terms of how traders are positioning for further barrels on the market?
I would say that in some ways this didn't come as a move that was a complete surprise. In fact, yesterday in our surveys, we found that most of the traders we talked to were expecting another supersize increase for July, especially since we've already seen two already. The other thing to flag, of course, is that while oil prices have come down, they've not come down to the same extent as they did for the previous supply hikes. So I think in some ways, even as this comes as important supply factor, it's also not a complete surprise. And so I think in some ways, like, this is a move that the market is somewhat prepared for. That said, I will also flag that demand picture is not entirely positive, and so I would say that this supply move comes at a time when the picture for the oil outlook remains well, less than positive.
Yeah, pretty murky outlook, isn't it, for oil right now, given all the tariff uncertainty. Nicholas Loire, Bloomberg's oil reporter, thank you for the latest in terms of the Bloomberg reporting on that potential increase in output again in July from OPEC+. Still ahead, we're going to speak to Brett McGonegal, the CEO of Capital Link, on his outlook for the US economy amid the tariff war and why he sees signs of clearing on the horizon. This is Bloomberg. Welcome back to Horizons Middle East and Africa. Happy Friday, everyone. I'm Tom McKenzie in London. Now, the US fiscal future is, of course, in focus as the bond markets bemoan Trump's big, beautiful bill. The Sell America trade dampening the dollar at the Qatar Economic Forum in Doha. The implications of Trump's tariffs were front and center to the discussions.
Consumers are starting to pull back on their spending, and business owners are starting to push off capital expenditures.
We just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates.
You have a substantial amount of uncertainty in almost every market.
The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment.
I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing.
And so you're getting back to, okay, this is a storm, but we'll get through the storm.
People used to be very U.S. exceptionalist, U.S., and we have seen some shift from U.S. to other countries since the beginning of the year.
I think we should all be very careful. There is too much debt in the system.
We have seen a de-escalation, but we still know that some tariffs need to be negotiated, that we're in a period of pause.
OK, well, our next guest sees signs of a clearing on the horizon, though, for US assets. Joining us is Brett McGonegal, Capital Link CEO. Brett, always great to talk to you. I want to start with the action in the bond markets and the overlay onto equities then. There seems to be a bit of a disconnect. Equities have largely held up. The bond market sensitivity is there. What keeps a bond market tantrum at bay at this point, given what is happening in terms of the deficit in the US and the ballooning build-out of debt?
Look, we're not going to get any drawback on the debt side, so we're going to have an expansion of debt. I don't think that that's necessarily the killer to the bond market right now. Excuse me. What I think is actually going to drive the bond market to bring the rates down is going to be visibility of the administration delivering on multiple fronts. One, on clarity around tariffs, and two, on what's the fiscal build out going to look like, and how can people get their head around where we're actually going. There's a big storm. We know, as I said, I think we're seeing some clarity here. It's going to still take a couple more months before I think everybody sees the complete economic picture. But this is a teardown of a conventional government and a rebuild. So I think that as you start to see more pieces come into play and there becomes to be clarity, the vantage point, I think, changes a little bit. It becomes less critical, and people start to probably applaud some of the stuff that's going on. And I think that's when you get your drawdown in rates, and then people will calm down a little bit.
OK, so that clarity and progress on some of those fronts will bring that optimism, or at least put a floor under some of these moves. When it comes to the equity market specifically, Brett, is there at least complacency as we see the bond market readjustments, and yet that relatively sustained strength in the equity market since April the 2nd? Is there a little bit of complacency there, that there hasn't been more of a read across into stocks?
Look, I think that people are using the word complacency. What I think you're seeing, is there isn't really a big thematic away from the U.S. market, tech, the Magnificent Seven, however you want to categorize where money goes, and I don't want to call it flight to safety, but maybe it's flight to quality. It's a trade that doesn't seem to want to stop. What I think is a different way to look at the complacency thing is it's an actual reaffirmation that that's where money goes in the world. And, you had this drawdown from those names. You had some sell-off there. And then the money kind of circles right back. So I think if you're looking at complacency in a negative format, I would turn that to say the complacency trade shows that the actual wheels are still turning on that trade, and that money, even though it cycles out on some sort of disappointment or uncertainty, it goes right back there. Because I just don't think there's a place where those large sums of asset allocations can go, and they keep finding themselves back in the same names. So I guess you could term it complacency, but I don't necessarily think it's a negative. I think it's more of an affirmation of the trade.
Okay, an affirmation of the trade. What assumptions, Brett, are you making about the trajectory of the dollar as you think about your US equity exposure?
Yeah, look, I think the dollar is not at levels that are that disappointing to me. I think it's off 7%. I mean, maybe it stabilizes around here or moves a bit from here. I don't think it goes back to all-time highs. I don't think you see a huge strengthening of it, but I think that's okay. I think what you're seeing is you're seeing a lot of different places where uncertainty is being priced. We know that uncertainty is normally mispriced in the market or overpriced, if you will. So you always get a tendency for people to overreact to uncertainty. So uncertainty over the fiscal policy, uncertainty over tariffs, uncertainty over the tax bill. You're going to get a bunch of uncertainty that shows through. We're seeing it in the bond market clearly. I think we're seeing it less in the equity market, and you're seeing it in the currency market. So I think everything's okay here. I don't think there's a big read-through. And as I said, one of the things that I think is a little bit interesting right now, and I've never been a person that really talks about Bitcoin. It's not my specialty. I think if we start to look at, is the Trump policy being understood? Is the trade happening? If you look at Bitcoin, he's probably the most influential person on the Bitcoin trade right now as vis-a-vis policy. So where is Bitcoin? Bitcoin's had this meteoric rise again in the last couple of months. I think maybe now we can start to draw some parallels that maybe that's the instrument that's showing first, the small successes that the administration's having. So rather than look at it as a speculative or an anti-gold or however you want to look at it, maybe this is the first read-through of the financial instrument that's portending where we're going to be. And I think for the first time, it's maybe giving the market a general indicator that I don't think it's had in the past.
Very interesting in terms of the call signals maybe coming through from Bitcoin. Currently trading at 110,000, holding above that level, which crossed course for the first time in history yesterday. Brett McGonegal, always appreciate your insights. A pretty constructive view there in terms of how things are shaping up for these markets. Capital Link CEO. Coming up, the challenges of powering AI data centers. We're going to hear from industry leaders speaking at the Qatar Economic Forum next. This is Bloomberg.
It's 5 gigawatts over a time period. Our particular piece and what we're really anchoring on is that we're going to do 1 gigawatt. And within that 1 gigawatt, about 200 megawatts, I'm sorry, I'm getting a little bit of details, but 200 megawatts coming online over the course of next year. So I think the way to think about this is it will likely go in a series of stages.
That was OpenAI's Chief Global Affairs Officer, Crystol Energy, speaking about partnering on a 5 gigawatt data center. Huge. And the cluster, of course, in Abu Dhabi, as it expands its Stargate AI infrastructure program internationally, beyond, of course, US borders. Sticking with AI, the challenge of powering data centers was at the heart of a panel discussion at QEF.
If you think about the conversations in data centers, they often lead to power, which is our number one constraint as an industry. To be able to find powered land is extraordinarily difficult.
The traditional path of how we build power is completely insufficient. We have to throw everything at the problem. It's solar, it's wind, it's hydro, it's, as the speaker before said, gas. Building microgrids, building grid-independent infrastructure is critical to the future of AI. And there's not a one single bullet solution. We've talked about nuclear power that's 6 to 8 years away. We have a real problem, which is how do we get the generation capabilities adjacent or near or into the data center? And this is the challenge that our industry has to deal with over the next 2 to 3 years.
That was part of a panel discussion on building AI's backbone, hosted by Bloomberg's Jumana Basechi at the Qatar Economic Forum. Now for a look at other stories crossing the lines this Friday. Turkey raising $2 billion from international markets in its second bond sale this year to take advantage of the recent slide in its sovereign risk premium. Bloomberg understands that the dollar bond maturing 2032 will yield 7.45%, down from the initial expectations of around 7.75%. The sale comes at a time when Turkey's credit default swap spreads have eased from highs reached in April, and broader emerging markets are recovering from a sell-off linked to the trade war. Egypt has cut interest rates for the second time in 2 months. The central bank reduced the benchmark deposit rate by 100 basis points to 24% and lowered the lending rate to 25%. The rate cut aims to boost economic growth before a likely fresh round of fiscal reforms this summer spurs renewed caution. It will allow Egypt to press on with its plans for an economic revival and ease some of the Middle East's highest debt servicing costs. And the world's largest green hydrogen project in Saudi Arabia, NEOM, is facing an uncertain future, with the project struggling to find international buyers for the fuel. All of the hydrogen from the project was originally intended for export as green ammonia, but with only one committed buyer lined up, it is now shifting focus to local consumers to fill the gap. The $8.4 billion project is the latest example of the challenges facing green hydrogen because of a lack of buyers. Bloomberg has learned France and Saudi Arabia are working on a proposal to disarm Hamas and transform it into a purely political entity that can play a role in future Palestinian governance. The proposal is part of preparations for a United Nations conference next month in New York, co-chaired by Paris and Riyadh, which aims to rally the world to recognize a Palestinian state. The objective is to make Hamas surrender its weapons in exchange for allowing it to retain some political power. But Israel is expected to resist the idea and insists that Hamas be given no role at all. Israeli Prime Minister Benjamin Netanyahu has appointed Major General David Zini as the new head of the Shin Bet Domestic Intelligence Agency. The appointment comes after the previous chief, Ronan Bar, announced his resignation last month amid a battle over his ouster. The Supreme Court has also ruled in favour of petitions, claiming the procedure was flawed. The appointment of Zini has sparked controversy, with legal watchdogs planning to appeal to the Supreme Court and opposition leader Yair Lapid calling on him to refuse the position until the court can weigh in. Let's check in on the markets right now, with European futures currently pointing modestly higher by 0.1%. S&P futures also range bound after a bit of a flat session on Wall Street. Stay with us. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Class action. The US orders Harvard to stop international enrollments, setting the stage for a court battle. Meantime, President Donald Trump's, quote, big beautiful tax bill passes the House, but the bond market is not convinced. Third time's a charm. Bloomberg has learnt that OPEC Plus members are discussing another supersized output hike for July. Plus, trade tightrope, how the world's biggest cobalt producer is balancing its China investment while wooing the White House. It's just gone 8:30 a.m. across the Emirates, 5:30 a.m. in the UK. I'm Tom McKenzie in London. Let's get to your markets then. After some very modest gains for the S&P 500, just 0.1% by the end of the close, the Nasdaq 100 was essentially flat for the session. The Asian session, though, you're on track for a sixth straight week of gains, up 0.5% on the MSCI Asia Pacific. European futures also on the front foot after losses of about 0.6% by the end of the close yesterday. So it's a bit of a down day for European stocks yesterday. Today, though, on the front foot, looking to gains of just 0.2%, but nonetheless in positive territory. The focus, of course, on the Treasury curve. We see the 5-year still above 5%. The 10-year at 452. You did see yields come down yesterday across the curve. We'll see to what extent that is a story that can be maintained as the focus continues to be on that tax bill, now heading, of course, to the Senate. 452 right now on the benchmark 10-year. The Japanese yen in focus with inflation coming in higher than expected in Japan. What that means, of course, for the BOJ in terms of their rate hike expectations. 143 right now on the yen, up 0.4% versus the dollar. Let's flip the board and have a look cross-asset at the oil story, of course. Gold and crypto, all fascinating assets in terms of the moves that we've seen this week. Oil in focus on the back of the OPEC Plus reports from Bloomberg that they are looking potentially to put more oil on the market, down 0.5%, so expected to be another week of softness for the oil markets. Gold getting a bid, up 0.6%, and Bitcoin holding above that $110,000 per coin level, which it crossed, of course, for the first time ever yesterday, but that's down 0.3% so far in the session as it holds above that 110 level. Now, gold heading for its biggest weekly gain in over a month, driven by investor concerns about the US fiscal deficit. Joining us now is Jason Rogers, Bloomberg's senior editor for energy and commodities. Jason, talk to us about what has been propelling gold after the softness that we saw, a bit of profit taking. It got to that 3,500 level. Now it's around 3,300. But the week itself has been pretty decent in terms of the flows into gold. Is this an ETF story? Is it a central bank buying story? How much of it is tied to concerns about the deficit in the US?
I think it's very much the last point there, Tom. We're holding it around about $3,300. It has risen this week. You've seen a rise of, say, 3 or 4%. And I think the new information is probably nerves around the US fiscal position. You did have a relatively weak 20-year Treasury auction. I think they were auctioning at 5%, and the demand even at that level wasn't very strong. And so you're clearly seeing nerves around the fiscal position, and that is fueling another sort of leg in the gold price in terms of its haven bid.
And you join us, Jason, of course, out of Shanghai. What role is China playing in the upside that we've seen for gold?
Yeah, I mean, in recent months or even years, you've seen really strong Chinese demand, propelling the gold price. And I think that leg of the rally is still there. We've just had import numbers that came out, and they were at an 11-month high. Clearly, the authorities are letting in a lot more gold at the moment. And you have a situation, I think, where even though prices are pretty strong, and that probably is affecting things like jewelry demand, there is still very, very strong investment demand for gold in China because people are basically nervous about how the world is turning, I think.
OK, Jason Rogers, Bloomberg's senior editor for energy and commodities. Thank you. In terms of what is supporting the gold price, in terms of the upside we've seen this week, central bank buying, the role of China, of course, ETF flows, but concern about the deficit blowout potentially in the US as the debt pile continues to grow on the back of this tax bill that, of course, makes its way towards the Senate. Back to one of our top stories today. Bloomberg learning that OPEC Plus members are discussing a potential third consecutive oil production surge in July. An output hike of 411,000 barrels a day is reportedly among the options under consideration. Joining us now is Carole Nakhle, Crystol Energy CEO, always with a clear eye on these oil markets. Carole, what do you make of the expectation now, at least the Bloomberg reporting, that OPEC Plus has been discussing another output hike? Is that a surprise for you? To what extent are the markets already factoring this in?
Of course, one has to expect always unexpected in all markets and with OPEC Plus policy and strategy. But this consensus seems to be today that OPEC Plus is one more time, for the third consecutive months, they are going to announce an acceleration of the barrels they want to release in the market from their previously withdrawn voluntary cuts. So they did that in May and for June, and now we're expecting to see that for July. So more than 400,000 barrels a day compared to 140,000 barrels a day. And that is an acceleration of putting all these barrels in the market. And that raises the question why they are doing this at a time when oil prices are in the low 60s, because more barrels would put downward pressure on prices. And the official line is that demand is growing and it will absorb those barrels. But the unofficial suspicion or motivation seems to be to punish those countries that have been overproducing, to push them to become more disciplined. That is the line, but I don't quite buy it, Tom.
OK, you don't quite buy the discipline line or the demand line. So what is it, do you think, that is the central factor that is motivating OPEC Plus at this point?
I mean, let's start with a disciplined one, because if you look at the history of OPEC Plus and OPEC in particular in Saudi Arabia, you can see that when they wanted to enforce discipline, they never really did it in a gentle way. They hit the cheaters with a big blow, and they simply opened the tap. So the reason why I said I don't buy that argument today about punishing the cheaters, there might be an element of truth behind that, but then why do it so gently? Why do it so gradually? And when I look at the demand, I don't see the demand booming. The demand is growing, but you feel like it's faltering, especially from China and Asia in general, especially in the light of the tariff threats and the economic uncertainty. So there is something else, a stronger motivation. On the one hand, I can look at maybe a deceleration of non-OPEC plus supply with shale, because shale is very sensitive to prices. So yes, we are seeing deceleration there, and therefore the additional barrels from OPEC are not going to flood the market because there's something else moving out of the market. And it could be that they are expecting a potential loss of significant barrels from the market, primarily from Iran, because President Trump offered Iran two scenarios, deal or no deal. And if there is no deal, then he's going to exercise maximum pressure and reduce their exports to zero. So these factors can justify the actions of OPEC if they triple their production release.
Well, on Iran, to your point, it's a binary outcome, it seems, deal or no deal. And the markets then, or at least OPEC Plus, making some assumptions about Iranian oil being taken off the market. As in fact, Iran has been, as you know, increasing its output, and China is a major buyer there. What is the Iranian story then through this potential binary scenario?
Iran, despite all years and decades of sanctions, it's amazing how they continue to export their oil, because, you know, I believe that they have mastered the skills of evading sanctions, and they have a very important buyer, which is China, and who doesn't care much about Western sanctions. So in a sense, yes, and we saw also the enforcement of sanctions under the previous administration. It was very weak, and as such, Iran managed to triple its oil exports. So today, if we see this really maximum pressure exercised on Iran, I doubt all Iranian barrels are going to dissipate from the market. They're going to disappear overnight. Even under his first term, President Trump managed to squeeze Iranian barrels to 500,000 barrels a day. Of course, we're going to see a loss of those barrels, but I don't think we're going to see 1.5 million barrels a day disappearing overnight. They know how to get them to the market somehow. I don't know how they do it, but they definitely know how to do it.
Yeah, and they have proven that, haven't they, Carole? I want to get your views in terms of the demand outlook then. We have various scenarios facing us in terms of how the tariff story unfolds as we count down to the end of that 90-day deadline, of course. If we get to a scenario we are base case 10% tariffs on aggregate into imports into the US, in terms of the demand impulse that that scenario would have, how are you thinking about that outcome and what that would mean for demand that seems to be soft around the edges?
Yeah, to understand the impact of tariffs, let's look a little bit at what was happening before the Liberation Day announcement and then after. So if I look at before that day, the tariff announcements, I was not seeing demand booming. Even if you look at OPEC Plus or OPEC forecast, the most ambitious forecast among the published outlooks out there, we could see that they had a softer outlook for oil demand for 2025 without the tariffs being announced. So I wonder today, I mean, with the tariffs, of course, they create uncertainty. They increase the costs throughout the supply chain. They increase the cost of living for consumers, depending on the countries that are being hit. And that by itself filters through the economic growth. And we can see, for example, the IMF in their latest outlook, you can see that it was red across the board. Most of the countries around the world received a downgrade in economic forecast. And that income effect will dampen further the demand growth. It doesn't mean that demand is not going to grow. It is growing, but it's definitely running out of steam. We can feel that growth is reducing. Some would argue that lower prices would boost demand. And yes, we are heading towards the driving season in the US, but I don't think the price effect would outweigh the income effect.
OK, Carole Nakhle, Crystol Energy CEO, on a picture of weak demand as OPEC Plus looks to be heading headfirst into a scenario of additional barrels on the market, potentially as soon as July, of course. Carole Nakhle, always with the smart analysis on these energy markets. Thank you. Now, the sovereign wealth funds of oil-rich Gulf nations, meanwhile, have piled billions of dollars into sports to gain returns, diplomatic sway, and soft power. This oil money is making its way into the sporting arena. Is it working?
In May, Donald Trump's inaugural state visits were in the Middle East, just like they were during his first term. Stop 1, Saudi Arabia.
That's a huge coup for Riyadh and for the Crown Prince Mohammed bin Salman.
Trump wanted the region's richest nations to pledge massive investments in the U.S.
With this trip, we're adding over $1 trillion.
$1 trillion, $600 billion. What is a mere $400 billion between friends?
Well, quite. And Gulf states aren't short of financial reserves thanks to decades awash with oil revenue. The vehicles likely making those friendly investments are sovereign wealth funds. These often opaque, misunderstood funds are closely linked to concentrated state power and strategic diplomacy.
They are increasingly invested in assets which are touching the everyday lives of people all over the world.
And in one area in particular.
You think about the feeling that you get when you watch the Olympics or something like that, that feeling of national pride. Sports is one of the few things that's really able to do that.
And this is all very relevant to a region that knows it can't rely on oil forever. So it's worth asking, what are Gulf sovereign wealth funds about to mean for you and the world?
Welcome back to Horizons Middle East and Africa. I'm Tom McKenzie in London. Time now for the Bloomberg Big Take. The US and China's fight for metals has found a new home in Congo's cobalt mines. In less than 2 decades, Beijing has formed a stranglehold over resources in the African nation. Now, Congo's politicians are trying to woo the Trump administration for investment while risking its relationship with China. Bloomberg's Ondiro Ogunga joins me now from Kigali, Rwanda. Ondiro, there is more than meets the eye then following DRC's decision to halt cobalt exports for 4 months. What is the story behind this?
Hi, Tom. So the government of the Democratic Republic of Congo made a surprising decision to halt exporting cobalt to the international market for 4 months. And this was not only surprising to the market, it caught their biggest investors and partners by surprise. CMOC, which is a Chinese company and the biggest producer of cobalt in the country, only learned about this decision from a Bloomberg report. And this is what makes it very, very interesting, because they're the biggest producer and they were hoping that they would get courtesy from their partners. And it's being looked at as a rebuke. This is a company that has large production targets, and they're very ambitious in the output that they're putting out. And the government of DRC feels like this has contributed in the free fall of prices that we're seeing in the international market. It also speaks to the growing frustration in DRC. President Felix Tshisekedi feels like the country owns these minerals, but they have little control. Control is in Beijing with China and some of these companies. And that is why we are seeing both of these people speaking in different tones when it comes to these minerals. And it's important for them because copper and cobalt account for nearly 40% of their GDP. Any slump in the international prices affects their development spending. This is a country that has been having a civil war internally. A large chunk of their money goes into budget. So any drop in revenue leaves them very vulnerable. This ban on imports is not only a warning to Beijing, but also it puts a target on President Felix Tshisekedi's back. It's a very, very big gamble. And if he doesn't play his cards right, it might not pay off big time as he's hoping it would.
Yeah, a very big gamble for, of course, commodities that make their way into electric vehicle batteries and beyond, of course. How does the US interest then? How strong is that US interest right now in DRC and its mineral deposits? And how is that interest kind of reshaping that race for critical minerals in the country?
Tom, it would be premature to say that that interest could be reshaping things right now because China has nearly 2 decades of dominance in the Democratic Republic of Congo. If you look at CMOC alone, they've invested $9 billion into mining in the Democratic Republic of Congo. And because of this, since 2016, they've tripled their copper production. They've increased their cobalt production to almost the same level that we are seeing cobalt hitting China. Trade with DRC was at $2.7 $27 billion, and you have trade with the U.S. at $820 million. China not only controls the mines, but they know the lay of the land, and they have people along the value chain and the ecosystem of minerals. Then you have the U.S. There was an opportunity that came up because of the conflict, and DRC is trying to woo them with minerals in exchange for security. And you have China saying that the U.S. is trying to profit from conflict, while the U.S. is saying that China's dominance is a threat to their industrial and technological advancements. So you have two countries that are trying to gain influence in DRC, but it's going to take a long way to get there because China has good logistic network. They have processing and refining ability. Almost 80% of cobalt is refined in their country, and they have been contributing in terms of loans and aid into transition minerals. So the U.S. has a long way to catch up. But as the big boys fight at the top, DRC is just trying to dilute China's influence and regain control of their minerals.
OK, and what happens in the DRC could, of course, have echoes beyond in the continent. And as you point out, China, of course, has embedded itself pretty deeply in that continent for well over a decade. So there is a huge gap for the US to have to fill and close. Bloomberg's Ondira Ogunga in Kigali, Rwanda. Thank you. Now for a look at some other stories we are following this Friday. Nigeria's ruling All Progressives Congress Party has endorsed President Bola Tinubu as its candidate for the 2027 election. That's after top opposition leaders agreed to unite under the African Democratic Congress ahead of the ballot. The move is aimed at repairing rifts that handed Tinubu victory 2 years ago when he won a tightly fought contest that left the head of the main opposition party as the runner-up. The UK has agreed to cede the Chagos Islands to Mauritius while retaining control of a strategic military base on Diego Garcia. The British government will pay an average of £101 million annually for continued use of the facility. The deal ends a long-running negotiation and achieves a key foreign policy aim for British Prime Minister Keir Starmer. Critics argue the agreement is a, quote, surrender. Ghana expects to earn $12 billion a year from small-scale gold production if output doubles as planned. The government set up a regulator this year to handle all gold buying and selling, the move aiming to boost foreign currency reserves and curb black markets trading. Ghana's gold exports rose more than 50% to $11.6 billion last year, with small-scale mining accounting for over 40% of annual output. Zambia's government says the country's corn harvest will more than double from a 16-year low last year to a record high. It follows better rains from last year's El Niño-induced drought, which led to soaring food prices and costly imports. The improved harvest could help quell rampant inflation and increase the chance of rate cuts. Coming up, Bitcoin hits a new high with trades increasingly bullish on the prospects of the original cryptocurrency. A little softer in the session today, but above still that $110,000 level. We're going to discuss how the Trump administration is helping its fortunes. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom McKenzie in London. Bitcoin surpassing $111,000 for the first time yesterday, currently just holding above that 110,000 level. The new high came on the same day that President Trump was hosting a dinner for top holders of his own meme coin. No conflict of interest there, I promise. Joining me now is Bloomberg's finance reporter, Subhashri Ghosh, in terms of what to think about some of the propellants for the crypto space this week. What are the main reasons then for Bitcoin breaching the all-time highs? Is it regulatory changes? We know there's a passage, a law working its way through the mechanisms in terms of the political mechanisms in the US. Is it the regulatory front? Is it the legal front, the policy front? Or is it indeed just Trump reiterating his support for the crypto space?
Hi, Tom. Thanks. And yes, actually, all of them that you mentioned to some extent. The key one is, of course, the regulatory clarity that is likely to emerge is one of the prospects that Bitcoin, investors are looking forward to. It's a stablecoin bill that was, that advanced in the U.S. Senate earlier this week. So that is one of the tailwinds. But more importantly, we've seen strong demand from institutions like the Bitcoin ETF issuers that has come through. We saw more than $600 million net inflow into the Bitcoin ETF funds. on May 21. That shows, and that was led by BlackRock, that shows how strong the demand from the traders and the investors are for Bitcoin. And then, of course, we all know about the sustained purchase of strategies, Bitcoin for its treasury management, which now holds $44 billion, which is about 2.6% of the total slated supply of Bitcoin. So there is an overall demand-led pressure for Bitcoin that is rising, that is leading to the surge in the prices. However, I'd like to kind of add a small thing over here, Tom, that this rise is basically concentrated on Bitcoin. The altcoins, the so-called altcoins, which are the smaller tokens, they have fallen behind in this rally. They are lagging. So it's not really a crypto asset wide, like, all tokens are not rising or rallying. It's just a Bitcoin-led rally in the market. So that's one thing that we have to take note of. That is a small part, though it's a big part. I mean, small part in the sense that just one token-led rally over here, though, which is contributes to 80% of the volumes, of course.
No, that's a really important point, isn't it, in terms of distinguishing between the moves of Bitcoin and some of the other crypto assets within the space, the drivers around the ETF moves, of course, and changes on the regulatory front as well. Bloomberg's Survashri Ghosh, thank you very much indeed on another big week for the crypto space, at least with Bitcoin in focus, crossing above $111,000 per coin for the first time on record yesterday. Let's get to the broader market picture right now. European futures pointing to modest gains of 0.1% after dropping yesterday. US futures pointing a little softer by about 1/10. The S&P 500 just managed to notch up gains by the end of the close yesterday. Nasdaq 100 futures pointing lower by 0.2%. A search for direction, it seems, with a continued focus as well on the treasury markets. That's Horizons Middle East and Africa. I'm Tom McKenzie. Daybreak Europe is up next. This is Bloomberg.